The following program is paid for by EG Tax. All opinions or statements expressed on this program are solely those of EG Tax or its guests and do not reflect the opinions of News Radio 930 WBEN or Odyssey.
The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk about taxes to make sure that you don't overpay. And here we are it's almost October. I can't even believe it. Like tomorrow is October the 1st. 3 months, October, November, December, and this year is done. So we want to make sure that we keep you abreast of whatever is happening. Make sure that we give you tax tips so that you don't overpay, and that's it for me. Now, normally, I'm joined every week with Tiffany Fabian and Christopher Fabian, and I have to tell you kind of something sad. They're down in Northville, in Asheville, North Carolina right now, and that's the remnants of Helene up there, and they are in a motel with no electricity, no water, no internet, no food, and they can't even get out of the area. So if you got some extra prayers, pray that they get out of Asheville, North Carolina. Plus that dam is talking about breaking. I mean, so if I never see them again, or if I see them floating down the Niagara River, I'll know what happened. Anyway, I'm Esther Gulius, the Tax Lady, 8030930. 8030930, star 930 on a cell phone. You can text at 716-8030930. I wanted to let you know that our tax school is starting this week. So if you thought you might want to go to tax school, it starts on Thursday. We have multiple locations. We will teach you A to Z about basic income tax, and it's absolutely great course. It's absolutely no charge except for the book. And it'll teach you about things that you never thought you would be interested in, and it'll completely really enlighten you as to when they're talking about taxes. You're going to find out that there's all kinds of things in there that you had no idea, and it ends up being kind of a social welfare situation. So, again, our tax school starts this week. The other thing is, if you think that you might be be interested in Ready, Set, Retire, we do that every year with the financial guys. That's coming up next month. And so you want to go to our website or the financial guys website to register for that. So, and the other day I was on the horn here with Tom Bowerly talking about school taxes. So again, anything you want to talk about, 8030930, 8030930, star 930 in the cell phone. And we have a special guest this week. We have Russ Gullo from R.J. Gullo Company. And so if you're somebody that has rental property, maybe a single, a double, maybe you have multiples. Russ Gullo is a certified exchanger, and he's here to teach you and me how you can save tons of money on your taxes by a very little known tax break. And we're very blessed to have somebody like Russ. And I thank you, Russ, for taking time out of your busy day to join us. So thank you.
Thank you, Esther. It's a pleasure.
So I just had a couple, I was telling you this before the show, I had a couple yesterday with 3 doubles that they want to sell, and their gain is probably going to be $600,000, right? So if they're really lucky and they're only going to pay about 40% in taxes, because with the state of New York, there's no special tax treatment, federal government maximum would be 20%, they're going to pay about $240,000 in taxes. And I said, you really should go see my friend Russ. Now, what would they have to do to get out of that kind of liability potentially?
So, Esther, they can take advantage of the best kept secret in real estate. And that secret, which is known as a 1031 exchange, actually has been available since day one when the Internal Internal Revenue Code came out back in 1913, actually.
Really? They had the foresight to think
They did,
about
and
that.
basically they changed the citation back in 1921 to Section 1031, but it was actually available prior to then. And your client, really, all they need to do is determine, do I want to pay tax or don't I want to pay tax? And to
Well,
save
there's a hard question to answer, right?
to save $250,000, I guess, is a no-brainer. And then the only other thing that they really need to determine is, do I want to be actively involved in ownership in my replacement property, or do I want to be passively involved? And other than that, they really only need a buyer, just like they would if they were to treat their 3 doubles as a sale. They just need a buyer. And then once they have a ready, willing, and able buyer, they bring in what's called a qualified intermediary, which is in
Who
the
is
business,
you?
which is us.
Right.
And again, we at the RJ Gullo Companies, we've been providing that service for 40 plus years. We were one of the first independent qualified intermediary companies in the country, actually. So we work together with them, with their entire team, their closing attorney or title company, their tax person, their real estate professional, and we kind of get them to the finish line, depending on what their game plan is. And we can go into details as far as the timeline.
So here's the thing. Every time I talk to people about doing this, just when you're doing all these numbers like 2106, 1031, people go, their eyes glaze over and they go, oh, that just sounds so confusing. But the truth is, they would list their 3 doubles for sale, right?
Correct.
But on the sale listing, it says that they're looking for 1031 exchange. Do they even have to say that on the listing?
They don't. And they don't even have to have anything in the contract of sale either. The only thing that's required is before the assets are conveyed to the buyer, they need to bring in a qualified intermediary anytime prior to legal title being conveyed to the buyer. So most of our business comes into our office, I'm going to say within 24 to 48 hours of the time from the actual closing. And that's nationally. So we kind of have to jump through hoops. But with the technology...
Are you saying they closed first and then they get
No,
you?
no. We have to get in their deal before they can close.
Okay, so, because as soon as you get money, the
Actual or
money is the
constructive
thing
receipt.
that ruins everything.
Yeah,
so.
they become taxable.
Right.
So they actually bring us in maybe 24, 48 hours
Just before closing.
just before closing. And at that point, all we need is a copy of their contract of sale. That's emailed to us. We prepare approximately 50 pages of 1031 documents. We give instructions to the closing attorney, so there's no actual or constructive receipt of the funds. And then at that point, upon the closing, that starts their clock. So they actually have a 1031 clock. And the day of closing is day 1. They need to ID what we call the 45-day ID period, which they're going to give us just a form. And that form will just list addresses. They do not have to be under contract or do not know what they need to buy at that point.
Okay, so I want to make this really simple because I think this is such a great way to save money. And I don't want people to think that this is something really mystical and hard. So I'm going to just correct me if I'm wrong. I'm just going to make it simple here. So I'm going to list my 3 doubles for sale just before it closes, because in order for this deal, which is going to, in this situation with my clients, $250,000, I'm not allowed to take any money out of this deal, right?
Correct.
In order to save $250,000.
Right.
So I have to take my money that I would have gotten on the sale and transfer that to another piece of property,
That's correct.
right?
Yes.
Now, the piece of property that I transfer it to, it could be my 3 doubles in Buffalo. I could transfer it to a villa in South Florida or in Texas, right?
Absolutely.
Right? I mean, as long as it's real estate, investment real estate for investment real estate, it qualifies.
Exactly.
Right? So I only have 45 days to let you know, the qualified exchanger, what the address of the property that I'm looking at to do this with. Is that correct?
And 180 days in total
To
to
close it.
Yes. So from closing of the sale, the relinquished property, we have 180 days to close the replacement property.
Okay.
And Esther, they can buy anywhere in the United States. They can buy more than one property if they want to be actively involved in ownership. Or today, as we were talking, a lot of our clients want to become passive and they want to go back into a management-free position. So all of that does qualify as what we call like kind.
Right. As long as it's real estate for real estate.
You got it.
Investment.
You got
I'm
it.
Esther Goulias, the tax lady. 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We have Russ Gullo here from R.J. Gullo Company. He's a qualified intermediary. Now, there are all kinds of investment properties in Western New York, doubles, triples, fourplexes. When you go to sell it, you're going to have to cough up the taxes in order to sell your investment property. What we're talking about today with Russ is how to avoid the taxes on that sale and kind of keep your investments under wraps so that ultimately it can pass to your children. And if that's the case, the kids would get a stepped-up basis and save you a lot of money. So anyway, if you have any questions about that, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break, and we'll be back with your calls, questions, and comments after the break. Hey, to us, you are family. I'm Esther Goulias, the tax lady from EG Tax, and we sure want to help you save money on your income tax. And we want you, and even over and above that, it isn't what you just save in taxes. It's what the bottom line is in your investment portfolio. Paying taxes is not something we like to do, but the bottom line is, after you've minimized your tax liability, you want to make sure that it was the best financial move for you at the same time. And that's really kind of what we're talking about today with Russ Gullo from R.J. Gullo Company, because it is true you're going to save money if you're selling your investment property using a 1031 exchange, but it really is one of the best moves you can make, not only just from a tax perspective, but from an overall investment perspective. So we have Russ Gullo here. So now, Russ, you were talking before the break, we were talking about how you could have a passive investment. What does that mean?
So, Esther, one of the first things we look at when someone decides to take advantage of the best kept secret in real estate is we ask them, do you want to be actively involved in ownership in your replacement property, or do you want to be passively
And
involved?
if they're retired, they might say, no, I want to sit under a lawn chair, under a palm tree in a lawn chair, right?
And we're seeing more and more of our clients are at that point in their careers where they want to be passive. So what I mean by passive is there's different investments that are available that qualify as what we call like-kind replacement properties. The most popular is called a DST, known as a Delaware Statutory Trust. And that's the entity that the IRS allows us to take advantage of as a replacement property. So typically what happens is we have a DST sponsor that may go out and acquire a $50 or $100 million or $150 million portfolio of multifamily properties throughout the United States, trophy-type properties, or self-storage properties, or student housing properties. And what happens is that investor that needs to go back into something as what we call a replacement property that wants to be passive, totally management free, they're able to seek the benefits as a normal real estate investor without the management. So they get their cash flow on a monthly basis. They get their equity build up, their appreciation at time of disposition, just like they would if they owned a property on their own. And there's typically a fixed holding period, an average of about 5 years that they're tied into. So they're able to, reap the benefits into a large portfolio where typically they would not be able to participate on their own in something of that size.
Okay, so now let me interpret. So really, here I am. I'm a regular guy. My 3 doubles. I don't really want to pay $250,000 in taxes because I'm selling these things. But I don't have to go find a big portfolio. That's something that your company would recommend.
Absolutely.
So
Absolutely.
there's nothing they have to do. It's just at time of closing, all of that money then goes to the
Qualified intermediary.
to your company,
Right.
who then would put them into that passive investment that would
Right.
then pay them monthly, right?
Exactly.
They would get just like they were going to pick up rents. But
Absolutely.
the difference is they don't owe any taxes. Then over a period of time, they could sell that if they wanted to later on. If they did, then they'd have to pay the taxes on it at that point in time. Or they could just leave it in their will for their family.
Right.
Right? And then the kids would get a stepped-up basis.
Exactly. So they're tied into a holding period of approximately 5 years. And then at that point, they have a decision to make. We can do another 1031. They could recognize the gain. They can do another DST, or maybe they want to buy a place in Florida, or depending on their game plan at that time. So they do have options.
But there's nothing. It's not like they have to put an ad in the paper. They don't have to go look for, gee, this looks like a Family Dollar that I'd like to buy. I mean,
Exactly.
that's the service that your company offers.
Exactly.
And the benefit to the client is they don't pay the taxes.
They keep 100% of their equity working for
I mean,
them.
that is unbelievable.
Doesn't get any better.
I mean, it is really unbelievable. I know a lot of times clients will call me up and say, gee, I'd like to sell my double, triple, fourplex, my 20 properties that I've had all these years. And I talk about the 1031, and for some reason, people think it is something that they have to do. You do it all.
Absolutely. We become the quarterback as the qualified intermediary, and we work together with the client, with the taxpayer, with their attorney, with their tax person, with their real estate agent, broker, and then we just bring them to the finish line based
Right.
upon what their objectives are.
And especially with the appreciation that's
Absolutely.
happened in the last few years. I mean, some of these houses that people paid $80,000 for is now worth $300,000. You know?
Absolutely.
And that's all going to be taxed.
Absolutely. And what a lot of people don't realize, Esther, is the recapture of depreciation. You know, the tax rate. When you do a 1031, you're able to take advantage of that as well. Not just state or capital gains, but also the recapture of depreciation. In a lot of cases, if they've been fully depreciated, I don't even have to do the math. I know if they're fully depreciated.
Zero basis, right?
Yeah, a third of their selling price is going to go to Uncle Sam.
Right.
And we can save them that full
And
amount.
and the thing is, and I don't think people realize this, the state of New York gives you no break selling capital assets.
Exactly.
All right. Federal government maximum you could pay is 20%. But on the state of New York, whatever tax rate you're in, that's what you're going to pay. There's no breaks at all. But when you do a 1031 exchange, you not only save federal taxes, you save New York state taxes
Absolutely.
too.
And believe it or not, one of the only states in the country that did not follow the feds was PA. And as of this past January 1, they now go along with the Fed. So I know there's a lot of listeners from PA
Yep.
that can now take advantage. And I know a lot of their tax advisors are not familiar with them being able to
All right,
take
so
advantage.
you're saying that in Pennsylvania, they required when you did a 1031 to kind of pony up to the bar at that point in time?
Yes, they had a
That was
clawback.
Pennsylvania.
Exactly, which is no longer the case.
Right. And that's what people don't understand is that the capital gains are taxed at a much lower rate on the federal. On the state of New York, there is no magic bullet as far as capital gains. But when you're doing the 1031 exchange, that's all covered as well.
Absolutely. Absolutely.
I'm Esther Gullius, the tax lady, with Russ Gullo from R.J. Gullo Companies, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And, so Russ, what is it that you would tell somebody if they're exploring? Do they talk to you now, or do they wait till the end? I know you said just before closing, the light goes off in somebody's head and they say, well, we think we'd like to do a 1031.
So the best play, Esther, is if someone is thinking of disposing of either income producing or investment held property, to call us as soon as possible. We don't charge them. We give them a free consultation. We work with them right to the conveyance of title. We don't charge them anything unless they close on the relinquished property. So they have our advice for free at that point. So we kind of do a consultation with them. We figure out what their game plan is. what is it that you want to buy? But before we get to that point, we kind of run them through a data collection form, wanting to know, have you owned the property for at least a year? Has it been available for rental, or is it investment held? We get a lot of people that are flipping properties today, and they don't realize that they are not eligible for 1031.
Right.
And so that whole education process, has to be in place prior to. So we put them through that type of a consultation, and then we determine, okay, you tell us what you want to do, and we'll show you how to get there. Do you want to be passively involved? Do you want to be actively involved? And then at that point, we prepare all their 1031 documents. We get those to the client, to their closing attorney, prior to them closing or conveying title, because everything has to be in place prior to, and then we're ready to go at that point.
Okay, and what I want people to understand is when you have depreciable real estate, investment property, and you are depreciating it, just like Russ was saying, that adjusts the basis of the property down every year. That's getting smaller and smaller and smaller. So upon the sale, basically, if you're selling it for $1 million and you've had it for 30 years and you've been writing off everything, it's going to be $1 million gain, which simple math is going to cost you about with 30% of $1 million, $300,000. So it's a lot of money. But this way is a way for you to sell effectively. It's really not selling, it's exchanging. Sell your property and not have to pay taxes. So if you're anybody out there that has been thinking about that, 8030930, 8030930, star 930 on a cell phone, and you can text us at 716-8030930. We're going to take a short break for the news. We'll be back on the other side. Thank you. Hey, to us, you are family. I'm Esther Golias, the tax lady from EG Tax. As I said before the break, Tiffany Fabian and Christopher Fabian are stuck in Asheville, North Carolina, in the remnants of Helene. They're in a hotel. They went down there for a wedding. No water, no electricity. No self-service, no food, no gas in the gas stations. So I'm praying to God they're going to be able to get out of there. But anyway, we have a special guest this week. We have Russ Gullo, RJ from RJ Gullo Companies, and we're talking about 1031 exchanges and anything else tax-related. And Russ, we have some text here. First is, Russ, remember it's tax-deferred, not tax elimination. And that is true, maybe, right?
Absolutely. This is not a once-in-a-lifetime opportunity, Esther. You can do a 1031 over and over again, and then the beauty of it is when we bid this world goodbye, our heirs are forgiven. They receive a stepped-up basis, as you mentioned, so at that point it's tax-free.
And that's true. I know that's been my whole game plan, defer, 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 and then when I'm lucky, I'm going to die. And then it goes to my kids at a stepped-up basis.
Absolutely.
So it is true that if you're doing a 1031 and you're planning on getting out before that glorious day, you will pay taxes. But if you just let it go into your estate, your children or your heirs receive it at a stepped-up basis. Okay, then the other one we got. If I sell owner-occupied duplex and I don't rent the rental half but live in both sides, how does that affect recoup depreciation?
So it sounds like they're taking a double or duplex and occupying the entire dwelling as a primary, so they wouldn't be taking depreciation. The whole dwelling would qualify under Section 121, which pertains to one's primary residence.
Which means that they can't do a 1031.
Which they wouldn't have to do a 1031, correct?
Right, because, so if they were renting it out and then they sold it, right? Then they'd have to. Yes. Either have to pay the piper, invest in another piece of rental property, investment property, or else they're going to have to pay taxes on that rental part.
And as we mentioned earlier, Esther, there are so many doubles and duplexes in area Niagara County in our marketplace, and a lot of those are owner occupied, meaning one of the two units, and the other unit is available for rental. And when that taxpayer goes to sell that asset, I can't tell you how many of them don't know that that's subject to taxation, the side that's available
Right.
for rental. The beauty of it is we can structure that portion as a 1031.
Right. But if the whole thing, let's say you have a duplex and you decide to live in the whole thing, then the whole thing is personal. And then when you sell it, if you're married filing a joint return, the first $500,000 is tax free. If you're single, it'd be $250,000. But if you rented it at any point in time, you still have to recapture that depreciation. Okay, let's see what we got here. Many people nowadays have concerns handing over large amounts of intermediary to an intermediary person. How do you protect our funds? That's a great question.
It is.
Actually, I saw a program about that. There was an unscrupulous intermediary, I believe in California, who just took the money.
The money and ran.
Yep.
Esther, that should be somebody's first question. They should be dealing with someone that has a track record, and we always recommend, if you have a property that you want to do a 1031 on and it's in Buffalo, you should be dealing with a qualified intermediary in Buffalo. You should not be sending your money to Chicago or California to save $10, because all you have to do today is go on the internet, and there's always going to be, like any business, a qualified intermediary that will have a price point that will undercut everybody else just to bring in business. But you want to know who you're dealing with. 99% of our clients are strictly referrals from tax people, from attorneys, from real estate agents and brokers. But to answer the question, we have a concept that's called flagging of the account, which means that the funds are guaranteed. They can't be released. Once they come into an account, they can't be released without their signature, and which is allowable by the IRS. They do not have signature power over the account, but they would have to send us.
So they don't have access.
Exactly.
But they are the approval.
You got it.
Okay.
You got it. And that's the same as having bonding without having the expense of a bond.
And the important reason that they don't have access would because in a 1031, if you do have access to the money, then that's a taxable event.
Exactly.
Right?
One of the first things an IRS agent is trained to look for is what we call actual or constructive receipt, meaning that if the funds do not come, the net proceeds do not come to the qualified intermediary, it's a taxable event.
Right. And so that's the bottom line. When you're doing a 1031, you don't walk out with the money, but by the same token, you don't pay the IRS at that point in time either.
Exactly.
So, okay, so let's see. We got what else I have as far as tax here. If I sell an owner-occupied duplex, the recouped depreciation is only on the rental half, and if that amount is low, is a 1031 worth it? That's a good question.
Right. So if it's owner-occupied, the depreciation would only be on the unit that's available for rental. So at that point, a decision needs to be made on whether or not it's feasible to do a 1031. They have to have a large enough of a gain in order to participate.
So I don't really want you to quote your fees over the radio, but I mean, are we talking about, is your fee like $30,000, $80,000, anything like that? Or
No.
is it much less?
Our fee is a flat fee, and our minimum fee is $2,000. Our average fee is $2,000.
And that's so reasonable.
So, Esther, in your example of your client selling for $600,000, I believe it was,
Right.
to save them $250,000, it would cost them $2,500.
Yeah, see,
Pure economics.
that's great. That's great. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. All right, so now the other thing is, what is a reverse exchange?
Esther, in a lot of cases, depending on the market conditions, you may have to acquire before you dispose of your relinquished property. So the IRS allows us, there's a RevProc that came out back in 2002 that allows us to acquire the replacement property before we dispose of the relinquished property.
Well, help me with that. Give me an example.
So you're down in Florida, you're vacationing in Florida, and you fall in love with a piece of real estate. Rule number one, never fall in love with real estate.
That's for sure.
So you fall in love with a piece of real estate, you go to contract, Down in Florida, as they use title companies, they close much quicker.
Right.
So now you're on your way back to Buffalo, and you're thinking, well, what property am I going to sell in order to achieve the reverse exchange? So what happens is they have to bring
All
in.
right, so you've already closed on this.
No, you can never own both properties simultaneously.
Okay, so the place in Florida you love, you're under contract, but you
contract.
haven't sold yet.
You got
Okay,
it.
all right, now help me.
So what happens is you bring in a qualified intermediary as well as what's called an exchange of combination title holder to take title to that asset.
The one you want to buy.
The one you want to buy.
Okay.
But that client has to be in a position financially to lend us the funds to make that acquisition. So we would go to title to that replacement property.
Okay.
Then the day we close on that, you then have 6 months to close on your relinquished property.
Well, that's interesting.
We would then have a promissory note with you as the taxpayer. Once your relinquished property closes, the net proceeds would come to the qualified intermediary, just like they normally would, and then we are able to reimburse the client by giving them back and paying off
The borrowed funds.
the borrowed funds.
But it could never be the gain.
Right.
It could
right.
never be tied to that sale price, that sale property, because then it would be taxable. Right?
Exactly.
That's interesting.
So we're able to buy before we sell with the proper structure.
That's interesting.
The wake-up item is you could
So
never...
tell me, give me an example when that would be. I mean, besides the person that fell in love with the property. So he's on his plane back to Buffalo, and he's thinking, "Gee, I don't have the money. I got to sell a place." Is that how it would be?
Or in a marketplace like Florida, as you know, has been so hot.
Right.
Cash buyers, where, unless you're buying for cash, you better get out of line at that point because the deal's not going to happen.
Right.
Because there's other people waiting. So in a lot of cases, because of the market conditions, you have to close on the purchase before you can close on your sale. And now you might be in a market that you have your relinquished property on the market, but it's not moving. Maybe because
and how much risk is the investor taking who's buying this place in Florida he's paying cash for? What if his property here doesn't sell?
that's the unknown. That's the risk.
So then do you shoot them or what happens in
So
that?
at that point, they may have made an acquisition, and they went
The
out
Florida property.
with the Florida property without selling. They're relinquished, and so they wouldn't have a good.
So then
reverse
they wouldn't have
exchange.
a 1031 exchange because they never sold the place.
Exactly.
Well, how long do they have to sell that place and still be able to do the reverse exchange?
When we take title to the replacement property, that starts their clock, their exchange.
So it's all
clock,
got to be done with that 180 days?
within 180 days.
Really?
Yes.
Wow.
Yeah.
Well,
yeah.
so that could be
There's
something somebody has
risk
to really
involved.
think about.
Absolutely.
That's really interesting. I didn't know that. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We got another text here, and it says, can I make available for rent a Florida condo for a few months, occupy it for a few months myself, and still call it a 1031 eligible investment property?
That's an interesting question, Esther. We get that asked all the time, but typically, if you bought, in our example here, a condo in Florida, you would have to make that available for rental and not have personal use of more than 14 days or 10% of the time.
Because then it loses its investment.
Exactly.
Criteria.
Exactly.
So the answer would be no then.
Right, exactly.
Right? Okay, so yeah, and for everybody to understand, you cannot use a piece of investment property for more than 14 days or 10% of the time it's rented and have it still be considered business property. And this whole thing is a business kind of tax shelter, right?
Esther, let's carry this a step further, though. Let's say that you bought a condo in Florida as your replacement property, and then you make it available for rental for a couple of years, and you decide that you want to convert the use of to personal use, primary or secondary. After the proper seasoning period, and again, there's nothing in the code or the regs that says what the proper
seasoning,
seasoning
right.
period is, you do have the ability to convert or abandon the use of that asset.
Well, as a matter of fact, I have a client, and he's our joint client, and that's exactly what he did. He had this wonderful unit that he had rented it for years, and then he decided that he wanted to make it all personal. This was after many years. And so it just changes nature from an investment piece of property to personal. But if he ever does sell it, he'll have to pay the piper. But if it
Right.
just goes into his estate, the kids get a stepped-up basis.
Exactly.
So it's really interesting.
Exactly.
All right, I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We have Russ Gullo from RGA Gullo Companies. We're talking 1031 exchanges. If you're an investor in real estate in Western New York or anywhere in Florida, Texas, whatever, the 1031 exchange could save you a ton of money, and that's why we have Russ here. We're going to take a short break. We'll be back with your comments, questions, and phone calls. Oh, yeah, the Bills are playing tomorrow. I love the Bills. Everybody knows I love. It's just I love them so much. I can't watch the game. I get upset. Do you? That never happens to you, Russ?
No.
Oh my God, I just can't. The other day when we were ahead by 37 points in the last 5, I always check to see what the score is, and I thought, oh, we're ahead by 37 points. I'll watch it. So I watched the last 5 minutes and I watched all the highlights, but I just don't have it makes me crazy to watch the Bills play. Anyway, we got Russ Gullo here from RJ Gullo Companies. He is a qualified intermediary. This, again, if you are somebody that's looking at selling your investment property, this is something that you might want to look at. It could save you a lot of money. We have another text here. Can you speak about doing a 1031 on property that may still have a mortgage outstanding?
Esther, I always tell our potential clients that, as a rule of thumb, the value contract price that you come out of, you want to go back into equal or greater value contract price. By doing that, what that means is that not only are you using the equity, the net proceeds, as your cash in the deal, you also have to go back into the debt that you're coming out of. Otherwise, it's known as what's called mortgage boot, subject to taxation.
Right.
So if you sold something for $100,000, you had a mortgage of $40,000, and you had net equity of $60,000. The $60,000 becomes the down payment. You procure a mortgage for the difference, or you can offset. If you don't want to go back into a mortgage, you can add additional cash out of pocket,
right,
to offset that.
Right. Okay. And then we got another one here. If I sell a duplex for $250,000 and half is rental with unrecovered depreciation, but I'm in the 0% tax bracket and my only income is $12,000 in Social Security, and $8,000 in rental income, does that lower my recovered depreciation, or is that not dependent upon my tax bracket? So, well, I can tell you, if you live in half, all right, then that you have to really consider it two pieces of property, in essence. Even though the duplex is one building, half is personal, half is investment. Now, if you really are in the 0% tax bracket and you sell that and there isn't much of a gain, you'll still be in the 0% tax bracket. But if you sell this for the rental portion for $125,000 and your adjusted basis is low enough, it's going to kick you out of that 0% tax bracket, because that'll end up going in as income. So in that situation, really the best thing you can do is half is going to be tax-free, but you're definitely going to pay some taxes. But it all depends on your filing status and what your expenses. Your $8,000 in rental income is going to be reduced by your expenses to operate. So it all depends on how long you had the house, what the depreciation was. If it's fully depreciated, you're going to have a $125,000 gain.
Absolutely.
So, but of course, they're not going to pay that much, because even they might pay $25,000 in taxes. But again, for $2,000,
$2,000,
hello,
$25,
right?
Exactly. Exactly.
Right. Anyway, okay, let's talk about what is a build-to-suit exchange.
Esther, a build-to-suit exchange is an opportunity where if someone decides, you know what, I want to go back into a brand new constructed dwelling, apartment, multifamily, single family that I make available for rental. So under the RevProc that came out back in 2002, the IRS allows us to do either an improvement exchange or a build-to-suit. So the difference is a build-to-suit is you buy dirt, land as part of your replacement. The exchange and combination title holder takes title to the land within that 180-day window, and new improvements are added to that dirt, so the taxpayer gets credit not only for the land purchase, but the improvements that are being added within that 180 day.
Now, when you say that the purchaser gets to add it, you're saying the adjusted basis goes up, right?
Well, you carry your basis
Right.
into the replacement.
Right.
So what happens is, if you sold, let's say you sold a piece of land for $100,000 and you were mortgage free. So you want to take that $100,000 and you buy a piece of land for $50,000 replacement property, but you have that excess $50,000 still sitting with the qualified intermediary.
Okay, and that's what you're going to use for partially purchasing the
Adding the improvements.
Right.
Right.
Okay.
Capital improvements. In addition to that, you can also procure financing or add additional cash if you wanted to build something for $500,000. Okay, you can still, and again, from a tax sheltering point of view,
So then the 180 days is strictly then to buy the dirt.
and make the improvements.
You have to make the improvements
Right,
with.
yeah.
So if there's nothing there and you're buying dirt, you can't build a house.
You're
with,
only going to get credit for the dirt at that point.
okay, but if that is the whole basis,
Right.
then
right.
you're good to go.
Right.
Right.
Right. Exactly.
And then everything else you would do would increase the basis on this property.
On the replacement.
Okay.
Correct.
All right.
And an improvement exchange is identical to the build-to-suit. The only difference is, and this is Buffalo, we're an older city. There's a lot of older properties. You buy an existing property that needs to be improved, a value-add type deal, where
Right.
you're able to go out, you buy at a wholesale price.
Right.
The exchange and combination title holder takes title to that asset with part of the proceeds that the qualified intermediary is holding, and then the balance of the funds and or any mortgage amounts are used to improve that asset. So you're creating value.
All right. So, but do I have to have this done within 180 days?
What you will get credit for whatever value, and they actually measure it by the cost of the 180th day period.
So, what if I have a contractor? Get rid of property A to get property B, and I got 180 days to do this, and my contractor runs off to Acapulco. Did I shoot myself in the foot?
You did. You want to make sure you're using contractors that are insured and bonded. but I mean, we have a lot of individuals that in my
So
example.
really, you really wouldn't get. You would really. They don't have like, oh my God.
No, not at all. Not
really.
At all. Not at all. And for that reason, because of our climate in Buffalo and
Yeah.
approvals with municipalities, that 180-day, you don't get extensions. The only time you'll get an extension is if there's a presidentially declared disaster like the hurricanes just
Right,
now
right.
in Florida. The IRS will come out, on their website
Right.
and tell us how long. Other than that, wherever you are at that 180th day, and the way to measure it is, what did you pay for the dirt? And show me receipts for the improvements that are already added to that piece of land.
Wow.
You can't just buy them. They have to be added so that they're deemed real property.
So if you sold a place for $250,000 on an exchange, and you had to put in at least, if this was just your adjusted basis, $250 on the new place, but you bought it for $150 and you were going to do $100,000 in improvements, and the guy dies, and you got to find a new contractor, and it's 181 days, you lose.
You got it. You only get credit for that 150 at that point.
Okay. All right. Well, that's all good to know.
Right.
That's all good to know.
That's Buffalo.
So really, it's a much wiser thing to buy a piece of property that's intact.
Right.
And then whatever improvements you do, you do improvements,
Exactly,
right?
exactly.
And then that it still increase
Right.
your
Right.
basis.
Exactly.
Okay. Well, I'm Esther Golias, the tax lady from EG Tax. We're here talking to Russ Gullo from RJ Gullo Companies. If you have investment property in Western New York and you would just like to sit under a palm tree drinking pina coladas and you really don't want to have to pay Uncle Sam, the 1031 exchange is really unbelievable. And I have to tell you, the saber rattling I heard this summer was that they are talking about getting rid of 1031 exchanges. And I will tell you that would cost people a lot of money. So you got to make hay while the sun shines. So if you're somebody that's thinking about this, especially when you take a look at how much property values have gone up, you'd be surprised how much you'd end up paying in taxes. So Russ Gullo and his company, RJ Gullo Companies, and you're in West Seneca, right, Russ?
Right. We're headquartered in West Seneca.
Right.
Right.
So, okay. And then last but not least, the DST investment. What is that? Oh, that's where you buy a
The
gigantic.
management free. Right. Right. It's an
So
opportunity.
you're in as a partial owner.
You got it. You got
And
it.
so they basically like give you a K1 at the end of the year, right?
So it's a great opportunity for those that don't want to be involved in the day-to-day management any longer.
Right. And I have a client that did that. He had a big piece of rental property in Western New York, and he lives in Texas, actually. And he did that, and he just gets like a K1 every year with a breakdown of all of his stuff, and he's out there in the Gulf of Mexico when there's no hurricanes fishing. And he has a wonderful life, and that's what he did because he didn't want to have to pay the taxes. So, all right, so if we need you, Russ, because people that are wanting to get rid of their property is going to need you, you're at 675-1500, right?
Or they can reach us. My web address is rjgullo, spelled GULLO.com.
Okay, so Russ Gullo is the founder and CEO of RJ Gullo Companies. He is a qualified intermediary. If you just don't feel like paying the federal government $400,000 to get rid of your property, Russ is the guy you want to talk to. He's at 675-1500. His website is rjgullo.com. And I really appreciate that you came in on a Saturday.
My pleasure.
Go
Esther.
Bills. That's
Always
what
good
I say.
seeing you.
I'll be in a closet someplace all day during the game tomorrow. All right, I'm Esther Golias, the tax lady. Don't forget, tax school starts this week. If you think you might be interested, go to our website at egtax.com. We appreciate your texts, your listening. And until next week, I'm Esther Golias, the tax lady. And hopefully Tiffany and Chris will be out of North Carolina by then. So thanks for listening. Have a great week. Bye-bye.
The previous program was paid for by EG Tax.